Well, speaking of what's on your feet, Wall Street feeling bullish on Birkenstock here today. Let's talk a little bit about this one. Company just went public recently. Several analysts now, including ones from Goldman Sachs, JP Morgan, Baird, Citi, they're all initiating coverage of the retailer with a buy equivalent rating following the company's public debut. Birkenstock shares are down over 10% since its IPO. It's not a sprint, it's a marathon, especially when you're wearing Birkenstocks. Ultimately, as of right now, though, you're seeing them over that course in time, seeing some slippage, at least in this early kind of moments as a publicly traded entity.
Yeah, certainly. I mean, I think my takeaway from this is the street is pretty much mixed on exactly how Birkenstock is positioned right now. There certainly are a number of outperform buy ratings on the stock. You can see 11 right there on your screen. Citigroup among the most bullish with the price target $52 a share. That's a jump of about 26% from current levels. Jefferies not too far behind with a price target of $50. But you do have 6 analysts out there with a hold rating. You talk about the fact of why they're staying on the sidelines right now, some of the reasons why we're that they're at least a bit apprehensive. Bank of America is one of those companies with a neutral rating, saying that while we view it as a strong brand with unique attributes, we think outsized growth on the top of the robust recent trends is going to be difficult. You talk about the fact that the consumer might be weakening just a bit. We certainly have seen a shift, or a pullback, I should say, in consumer spending. How exposed a company like Birkenstock is something that is up for debate right now, because many of the bulls out there that do have that buy or outperform a rating on the stock right now, saying that they have a very loyal customer base and they're going to be able to weather this uncertain time better than some of the rivals. But you got to take into account that consumers are being a little bit more cautious in terms of spending right now and pulling back on some of their purchases.
It's an expensive clog. It's not cheap. It is comfortable, but at the end of the day, I think for what Goldman Sachs is looking at here too, and what they had said, they're looking at the compound annual growth rate, expecting that to be between this year and calendar year 2026 to be about 18% in that CAGR, compound annual growth rate there. And then so additionally, just saying at this point, at least, shares look attractive on a growth-adjusted metric basis. So whether you're buying the clogs, whether you're buying the sandal, I mean, I've tried them on. They're pretty good.
They are very comfy. I actually don't own a pair, but I know a lot of people who are very loyal customers, and they come back buying more and more. And I also think one of the questions here from analysts is what that growth trajectory looks like in terms of more products potentially here in the future. If they're able to further diversify outside of the clogs, which they are so well known for, obviously. You talk about the fact that they could potentially expand into orthopedics, professional, outdoor, active, kids, home, sneakers. The options are endless. It's just whether or not they do follow that route and expand their product line, and then what that could in turn do to their customer base.